Your money is at risk as insolvencies have started and more coming. I'm your host, Steve Van Metre, and thanks for joining me today. And when the Fed starts to pull liquidity out of the markets and asset prices fall, well, insolvencies start to rise. And investors find out that what they thought their money was good, it turns out that companies were taking extreme amounts of leverage and risk. And without rising asset prices, many start to go bust and investors get wiped out. And this, my friends, is just the beginning. Let's head over where we picked today's story up as U.S. state regulators say it believes crypto lender Celsius is deeply insolvent. And Vermont's Department of Financial Regulation on Tuesday said it believes cryptocurrency lender Celsius Network, which we've covered, is deeply insolvent and does not have the assets and liquidity to honor its obligations to customers and other creditors, meaning very simply that people that have their money with Celsius are unlikely to see any of it come back. The crypto lender has been involved in an unregistered securities offering, selling cryptocurrency interest accounts to retail investors, including investors in Vermont, it said in a statement. Celsius also lacks a money transmitter license and until recently was operating largely without regulatory oversight. Due to its failure to register its interest accounts as securities, Celsius customers did not receive critical disclosures about its financial condition, investing activities, risk factors, and ability to repay its obligation to depositors and other creditors, according to the regulator. The state agency said it now joined a multi-state investigation of Celsius. State securities regulators in Alabama, Kentucky, New Jersey, Texas, and Washington are investigating Celsius' decision to suspend customer redemptions. And as we talked about in a previous show, last month, Celsius froze withdrawals and transfers citing extreme market conditions, leaving its 1.7 million customers unable to redeem their assets. And then when regulators start to get involved, particularly more than one, it's all downhill. And for the rest of the industry, the crypto industry, they should put on notice, because where regulators find one bad apple, well, they know there's more. And let's continue with this Celsius story because it gets even more interesting as they refuse a bailout. And Celsius repays $113 million of loans as crypto lender fights for insolvency. The company repaid loans to Aave and Compound on the last day of them being due, and so far has paid off $300 million of loans since July 1. Meanwhile, customers still locked out. But our friends over at Blockworks report that Celsius lost potential $6 billion bailout after refusing to show financials, according to investors. The company has kept its balance sheet private while playing down its loans. And Simon Dixon, the CEO of prominent Celsius investor Bank to the Future, said this morning he secured up to $6 billion investor liquidity to solve Celsius liquidity woes, only to watch the deal fall apart after Celsius refused to show its financial records to potential customers, which should be a massive red flag when a company doesn't want to disclose its financials. It tells you there's something seriously wrong under the covers. Dixon's comments came in a YouTube interview where early Bitcoin adopter turned crypto investor described his proposed recovery plans for Celsius, which the company declined to follow. And Dixon advised Celsius CEO Alex Mashinsky to transparent about the company's financial situation and publicly outline a recovery plan. The CEO declined to make Celsius' financial situation public. The only reason you wouldn't pursue a lucrative round of investment is simply there's something else going on, because nobody in their right mind, neither you nor I, would turn down $6 billion in seed money, particularly if your company was going under and you needed it. And then to make the story even worse, we switch back over to Three Arrows Capital, a story we've been covering, as it looks like the heads of that company are fleeing. And two prominent crypto fund managers are on the run. And what's probably a sign of things going terribly wrong, two former billionaire crypto hedge fund managers have disappeared, spurring a worldwide manhunt to find them as a broader industry freezes up. And again, this is that liquidity story. You start to see the Fed starts to pull back on liquidity. Asset prices come down and things go insolvent. And when they do, they go really quick. And that's why as the stock market and crypto space and other asset classes head down, you're going to see even more of this as the Fed continues to tighten. The two traders, Su Zhu and Kyle Davies, are co-founders of Three Arrows Capital, the Singapore-based fund that had once boasted of having as much as $10 billion in assets, pretty much all of it in digital currencies, non-fungible tokens, and the like. The duo, who are both educated at Phillips Academy and over in Columbia University, and both work for Credit Suisse, may be responsible for billions of dollars of losses all over the world. And the fund blew up last month following the May annihilation of two of the world's largest digital currencies by market value, Terra USD and Luna, which we cover on this show, and wiped out about $60 billion from the market in 3 days. Going on, Three Arrows has since been ordered by a British Virgin Islands court to liquidate its holdings in order to pay back its creditors, an order so far that's gone unheeded. And of course, on Tuesday now, though, the Manhattan federal judge greenlit subpoenas for Zhu and Davies, whose whereabouts are still unknown. And of course, it makes you start to wonder if they're going to take whatever money's left and run. Certainly a possibility, and that's what's got investors worried that perhaps there indeed is actually nothing left. And that is terrible news. The two told the Wall Street Journal that they're in fact cooperating with liquidators, and Zhu told Twitter to post a letter from his attorney saying that they and their families have been threatened with physical violence and accused of Tenneco of baiting them for not buying a cryptocurrency they're invested in. And no surprise, when you lose billions of dollars, you're probably going to get some death threats. I know, never happened to me, but I can just say that without any relative fact that this is probably a legit concern they have. Of course, where it will go, we don't know yet. But what happens next is that presumably Zhu and Davies would give up a full list of the fund's assets, one would hope, and cooperate with the liquidators who have now essentially taken the fund over in order to sell everything off. The proceeds from that sale will go back to the companies and individuals who owe the fund money, but by no means a guarantee that anyone will get all of their money back. And before any of that happens, though, Zhu and Davies, well, they've got to come out of hiding. In fact, the reality of the story is little or none of that money is coming back to investors. And if you're concerned about anything of these insolvencies that could lead to a broader market sell-off and a decline in your portfolio, well, you shouldn't be. Be sure to check out Portfolio Shield. I'll put a link up here in the corner and description below. The one strategy that is hedged against these risks, that Jeff Snyder, our chief strategist himself, is well positioned for what he considers is a deflationary recession coming soon. And on that topic, let's pick up today's story where we see the CPI heading higher, but the bond market's saying, nah, we don't think the Fed is on the right path, and they're about to make a huge mistake. As U.S. inflation quickens to 9.1%, amping up Fed pressures to go big. And consumer price index climbed a whopping 1.3% from May, the most since 2005, blowing out analyst predictions. Increase reflected higher gasoline, shelter, and food costs. Economists projected a 1.1% rise from May and an 8.8% year-over-year increase based on survey medians. This was the fourth straight month that the headline annual figure topped estimates. The so-called core CPI, which strips out the more volatile food and energy components, advanced at 0.7% from the prior month and 5.9% from a year ago, also above forecast. And if we look at where the inflation is coming from, you can see it's heavily driven out of the energy sector, which in June was up 7.5% year over year. We've driven largely by gasoline, up 11.2% year over year, and pipe gas service at 8.2% year over year. Now, when we strip out food and energy, although food was only up 1%, making the increase in gas look really actually huge, when we come down to the less food and energy section, we still see the two biggest drivers are used cars and trucks, which we're hearing from industry insiders is likely to come down, and transportation services, which of course that is being driven by higher energy costs, and that too likely to come down as oil eventually falls. But let's continue on and we'll take a look and see, is inflation likely to come down or not? Well, it is, but let's get there first. As the red-hot inflation figures reaffirm that price pressures are rampant and widespread throughout the economy and continue to sap purchasing power and confidence. That will keep Fed officials on an aggressive policy course to rein in demand and adds pressure to President Joe Biden and congressional Democrats who support a slump ahead of midterm elections, which is quite common during periods of high inflation. And while many economists have suggested this data will be the peak in the current inflationary cycle, several factors such as housing stand to keep price pressures elevated for longer. Geopolitical risks, including COVID lockdowns in China and Russia's war in Ukraine, also pose risks to supply chains and the inflation outlook. And what that means, all that means is inflation likely to continue? Well, the answer is no. And because when we take consumer price index here in blue on a year-over-year rate change, and we overlay crude oil prices, West Texas Intermediate on a year-over-year rate of change, what we can see is that crude oil prices lead the CPI. So here's a good example coming out of the year 2000. You see on a year-over-year rate of change, crude oil prices went down, and CPI, lagging effect, eventually followed with it. And you see as crude oil is rising, inflation is rising. You see crude oil falling, inflation falls. Notably, it's lagging that move. Here we see crude oil headed down, and that tells us that inflation is likely to fall. And the bond market, as I mentioned, is kind of laughing at the Fed right now, saying you're making a huge policy mistake because the bond market's not buying into this either. Now when we look at the 30-year Treasury yield overlaid against the Consumer Price Index, we can see that there's periods where inflation is rising and yields start to head down. And what that is, in fact, is here is again, here we can see yields falling and bringing inflation down is what the bond market's telling us. Is not only is the Fed making a huge policy mistake here, but the bond market doesn't buy into the fact that inflation is a monetary phenomenon. And of course, this all wraps back in to Jeff Snyder's research, who we know have said a deflationary recession is on tap potentially later this year or early next year. And if that happens, well, that means the Fed's going to be cutting in a big way, although not in 2 weeks, as we expect to see, as now the traders fully price in a 75 basis point Fed hike at the July meeting, and tightening bets are boosted ahead of the key inflation data, with Powell saying both 50 and 75 basis point moves are on the table. But if you want my prediction on this, well, I'll tell you what, I think a 1% increase is absolutely now on the table. And let's head back over to our buddy Jeff Snyder, whose daily research report picks up on a story we talked about yesterday. Now, if you're wondering how you can learn from the master himself, well, in the description below, there's a link for marketsinsiderpros.com. Go there, put your email address in, and for a limited time, you can get Jeff's daily report and deep dive, and your first report will come out in the morning, 8:30 a.m. Eastern. Let's continue on, because the U.S. data now says small business optimism index, as we talked about on yesterday's show, the NFIB reported small business optimism index tumbled to 89.5 in June 2022. A net 61% of survey respondents told the NFIB that they expect worse business conditions over the next 6 months. And Jeff notes a record low for the survey that has been kept for 48 years. And looking at his interpretation, we see that cost pressures are the most obvious driver of pessimism, with slightly more than a third citing those as their biggest problem. This simply means small businesses in general are unable to pass along most or even some of their input cost pressures they've been dealing with since last year's supply shock, further demonstrating how the situation is opposite of inflationary. He goes on to say these findings are sadly perfectly consistent with at least a serious probability of an imminent recession, perhaps one now underway. In fact, a net negative 2% said they've experienced higher, meaning lower, nominal sales over the past 3 months, and profitability now stands at alarmingly net negative 25%, with 30% blaming costs for lower profits and another 16% stating lower sales, up sharply in June. And if there's one person I look to every day to learn more about the markets and what's going on in the economy, that's Jeff, and you should too. And with that, let's wrap today's show up, because remember, where one insolvency begins, more are soon to follow. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.